Hello, friends. If you are 65 or older, or you're going to be soon, the federal government quietly created a brand new tax break with your name on it, and a huge number of the people who qualify for it right now have no idea it even exists. I want to be straight with you from the very start because you've probably seen 100 videos promising free money, and most of them are nonsense. This one is real. It is written into federal law. It is on the IRS website under its own name. And it started with the exact tax return millions of seniors are filing right now. It's officially called the Enhanced Deduction for Seniors, and most people just call it the $6,000 senior deduction. Here is the part that matters. It is worth up to $6,000 per person. If you're married and you are both 65 or older, that is up to $12,000. And unlike almost every other tax break out there, you get this one whether you take the standard deduction or you itemize. That almost never happens. Normally, you have to choose one path or the other. This deduction stacks right on top of everything else you already get, but here is why I am making this video. There are seniors who qualify for this and are still going to miss it. Some will miss it simply because nobody told them. Some will sit down, fill out their return, skip one box, and never see a dime of it. And some already filed without it and don't realize they can still go back and claim it. I am going to walk you through exactly what this is, exactly who gets it, the specific traps that make people lose it, and the one thing you need to check before this window closes, because it does close. This deduction is temporary, and I'll give you the exact deadline near the end. Before we get into it, if you're not subscribed to this channel yet, take 1 second and hit that button right now and turn on the bell. Here is why it genuinely matters to you. Tax rules for seniors are changing faster right now than they have in years. New deductions, new income limits, new forms, new deadlines. And when they change, nobody mails you a letter explaining what you are now entitled to. They change the rule and expect you to already know. What I do on this channel is take these changes and break them down in plain English so the money that is supposed to reach you actually does. The people who are subscribed find out in time to act. The ones who aren't tend to find out after the deadline has already passed. So subscribe now and let's get into it. Let me start with what this deduction actually is, because there's a myth going around that I need to clear up first. A lot of people have heard that seniors no longer pay any tax on Social Security. That is not what this is. Your Social Security benefits are still taxed under the same rules as before. What Congress actually did was create a separate deduction, $6,000 knocked off your taxable income before your taxes even calculated. It is not a check that shows up in your mailbox. Nobody is mailing you $6,000. What it does is lower the amount of your income that gets taxed, which lowers the tax you owe. I am telling you this plainly because I would rather you understand exactly what you are getting than get your hopes up over something that was never true. So what is it actually worth in real dollars? That depends on your tax bracket, because this is a deduction, not a credit. Most seniors living on a fixed income sit in the 12% bracket, and a $6,000 deduction there saves you about $720 on your tax bill. If you're in the 22% bracket, it's closer to $1,320. And for a lot of people watching this, it does something even bigger than that. It can wipe out your federal income tax entirely. Let me show you how that works. For the 2025 tax year, a single person 65 or older gets a regular standard deduction of $15,750. On top of that, there's an extra standard deduction that seniors have always gotten, which adds another $2,000. And now, on top of both of those, sits this new $6,000 deduction. Add it all up, that is $23,750 of income shielded from federal tax for one person before you count a single other thing. For a married couple where both are 65 or older, the total climbs past $46,000. If your income is at or below those numbers, there's a real chance you owe the IRS nothing at all this year. A lot of seniors on Social Security and a little bit of savings land in exactly that zone and never realize it. Now let's talk about who actually qualifies, because the rules are specific and one of them trips people up. First, you have to be 65 or older by the last day of the tax year. For the 2025 return, that means you were born before January 2nd of 1961. If you turn 65 on January 1st of 2026, you don't get it for 2025, but you will get it for 2026. Second, you need a valid social security number. And if you are married and both of you are claiming it, then both of you need one. Third, and this is the one that catches people, if you are married, you have to file a joint return. Married filing separately disqualifies you completely. Both spouses lose it. So if you and your spouse have been filing separately out of habit, this is worth a hard look, because filing jointly for this 1 year could put $12,000 of deductions back on the table. There's an income limit too, and it is not based on the number most people expect. It's based on something called modified adjusted gross income. If you're single, you get the full $6,000 as long as that number stays under $75,000. For a married couple, the full amount holds up to $150,000. Above those lines, it starts shrinking. 6 cents of deduction gone for every dollar you are over, and it disappears completely at $175,000 for a single person and $250,000 for a couple. Here is the trap hiding inside that. When you take money out of a traditional IRA or a 401k, that required withdrawal counts toward this income number. So a senior with an otherwise modest income can take one large required distribution, cross the line, and lose part of the deduction without ever seeing it coming. If you are anywhere near that threshold, it is worth timing those withdrawals carefully. Here's a real example of how this plays out. Picture a 72-year-old widow living on Social Security and a small amount of interest from her savings with a total income of around $30,000. She always took the standard deduction and never thought twice about it. This year, between her regular standard deduction, her existing senior add-on, and this new $6,000 deduction, her taxable income drops all the way to zero. She owes no federal income tax at all. But here's the thing. If she'd used the wrong software or filed a paper return and skipped a new form, that deduction could have sat there untouched, and she'd have paid tax she never actually owed. That is how quietly this gets missed. So here is exactly what to do about it. This deduction is claimed on a brand new form the IRS created called Schedule 1A, and the senior deduction lives in Part 5 of that form. The result flows onto your main tax return, Form 140, on line 13B. If you use tax software, whether that's TurboTax, H&R Block, Free Tax USA, or the IRS Free File program, it handles this automatically, but only if you enter your date of birth correctly and your social security number is filled in right. So do not just assume it happened. Before you file, open up the Schedule 1A section and confirm with your own eyes that the deduction is actually there. If you file on paper, you have to complete Schedule 1A yourself and attach it and double check that your social security number is written on it, because a missing number means the deduction gets denied. And if you already filed your 2025 return and didn't claim this, do not panic and do not just let it go. You can file an amended return using Form 1040X to claim it and get back the money you overpaid. You have up to 3 years from the filing deadline to do that. So if you catch it now, this is not a missed it forever situation. And if you would rather not do any of this on your own, there is free help built exactly for people your age. The AARP Tax Aid Program and the IRS's own Vita and Tax Counseling for the Elderly programs will prepare your return for free, and they know this new deduction inside and out. You do not need to pay a preparer hundreds of dollars to get this right. One more thing, and this is the part I promised you at the start. This deduction is temporary. It exists for the 2025 through 2028 tax years, and then, unless Congress votes to extend it, it is gone. That is 4 years, and one of them is already behind us. So this is not something to file away and get to eventually if you qualify. This is money sitting on the table for a limited number of years. And every year you don't claim, it is a year you never get back. So let's bring it all together. There is a new federal deduction up to $6,000 per person, $12,000 for a couple, for anyone 65 or older. It works whether you take the standard deduction or you itemize. It can lower your tax bill by hundreds of dollars, and for many seniors, it erases federal income tax completely. You have to be 65 by year's end, you cannot file married separately, and you have to keep your income under the limit. You claim it on Schedule 1A, line 13B. If you missed it last year, you amend it with a 1040X, and the whole thing disappears after 2028. Nobody from the IRS is going to call and remind you this exists. The only difference between the seniors who get this money and the ones who don't is knowing that it's there and taking the one step to claim it. If this helped you, do me a favor and subscribe and send it to someone you know who is 65 or older or getting close, a parent, a neighbor, a friend. One conversation could save them real money this year. I'll see you in the next one.